So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable? Or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again?
So it seems to me like we're headed into a pretty serious downturn or recession here. I mean, I've been saying we're in a recession for months. The tricky thing for the Fed is that they don't have a lot of good options, because we have a lot of recession indicators blinking red right now. At the same time, inflation is still high. So they're kind of caught between a rock and a hard place.
Few people have come close to such a perfect summary of the Federal Reserve's predicament. Using only a few words, American investor and entrepreneur David Sachs sums up the current malady of the United States Federal Reserve. In his words, the central bank is currently caught between a rock and a hard place. The rock will be to allow inflation to go higher unchecked, with several disadvantages, especially for average American families. And the hard place is getting a hold on inflation only to enter an extended and possibly severe period of economic decline. In a recent episode of the All In podcast with Chamath Palihapitiya, David Sachs, David Friedberg, and Brad Gerstner, the crew extensively discusses the big elephant in the room, which is recession. Chamath predicts that the current rally in the stocks market, which has once again pushed the S&P above $4,000, will be short-lived. Brad Gerstner, the founder and CEO of Altimeter Capital, and Sachs also discussed the Federal Reserve's part in the high inflation rate and how policymakers could have curbed it earlier instead of saying it was transitory. Please watch the video to the end, as it promises to be enlightening. Also, ensure you like this video, subscribe to the channel, and drop your comments, thoughts, and observations in the comment section below. Enjoy.
We still had some amount of rate uncertainty from the Fed. I think people weren't sure how aggressively they were going to hike. But by early this week, it was pretty clear there's going to be 2 50-point hikes, one in June and one in July, and then effectively a pause, because then the Fed funds rate will be at around 2%. And everything from there will probably be path and data dependent. Okay, that's effectively what they said. Now, I think the markets had actually already started to see that writing on the wall. So if you go back to, one of our favorite measures, which is the 10-year break even, it's effectively rolled over, which meant that, which means that from the highs in sort of late April, it started to come down, which says that, they were thinking that, the inflation was not going to be as bad in the back half of the year. And then the second is that corporate credit, which is really what matters in some ways to the Fed, because that's where they can intervene. What is the spread above treasuries that a company can issue debt? When it goes crazy and it goes up, it means, oh no, the cost of capital is going up. That's going to be hard for companies to raise money. They may have to lay people off. They may need to get into cost-cutting mode, right? That's what goes through everybody's mind. But that's also now about 35 and 40 days rolled over, which means that the gap has started to shrink, between the US Treasury price and what, decent corporates can issue debt at. So it looks like we are set up for potentially a decent little rally here. The problem is it a rally that is sustainable? Or is it a rally that's basically what we call a dead cat bounce or a bear market rally, where, you just get some 1 or 2 weeks of relief before the thing spears down again? So right now we're in a moment of pause, and there is the potential, if this data comes back as reasonably good, which means prices are, not escalating as much as we thought, inflation is not going to be as bad, growth is going to be moderate, that gives a lot of ammo for the Fed to kind of take their foot off the gas here. And in that case, the markets will go boom.
Well, the costs of buying a home are going way up because home loans are now more expensive. So that's going to factor into all sorts of consumer purchases. Anything that's financed is going to be more expensive. You're also seeing companies starting to slow down spending, really starting to slam on the brakes. We see it in startup land. Startups are all slashing costs right now, but that's eventually going to percolate up to big companies too.
Gerstner, the founder and CEOs of the life cycle technology investment firm, a guest for the episode, also explains how the Federal Reserve and other policymakers have been given mixed signals since it all started. They said it was transitory while they should have been working tirelessly to control it. Know that they are trying to do anything significant. The damage to the economy is already quite extensive. Plus, there is no doubt that the excessive money printing brought us here will begin with.
You saw Dara's memo, basically when he got back from Wall Street. Remember, he published that a couple weeks ago saying we need to sharpen our pencils, cut everything. What Wall Street is looking for now is free cash flow. So it seems to me like we're headed into a pretty serious downturn or recession here. I mean, I've been saying we're in a recession for months. The tricky thing for the Fed is that they don't have a lot of good options because we have a lot of recession indicators blinking red right now. At the same time, inflation is still high. So they're kind of caught between a rock and a hard place. I think what the Fed should have done is, in 2020 hindsight, is back last summer, we first got that shock CPI print. Remember, it was like 5.1%. Seemed to come out of the blue because for years and years we've been talking about deflation. Nobody thought inflation was a problem. All of a sudden we got that 5.1% print. They were in total denial about it. They just dismissed it, saying that inflation was transitory. And Yellen said the same thing. And so basically everyone just ignored the data for 6 months. And what they should have done was stop QE right then and there. They could have taken a little bit of time to think out, a rate increase strategy, but they were still basically engaging in QE for 9 months after that, first inflation warning. And if they had stopped QE there, then we wouldn't have had this asset bubble in the second half of last year. That's when it inflated the most. And we could have had more of a soft landing. Unfortunately, now they kept inflating, and really until the end of Q1. And they've yanked away the punch bowl so violently that I think the real economy is going to go into recession. So that's where we are right now. I mean, I don't know what the right answer is now, given that we're in this, almost stagflationary position.
Listen, the Fed said two really important things this week. They said, number one, our communications have been helpful in shifting market expectations. What that means, the Fed is the air traffic control. They said to the markets at the beginning of the year, you're 90 degrees off runway heading. Get your ass back on runway heading. It was a slap in the face to markets, and it was a radical adjustment. Now you hear the Fed in these little statements. This week, they said, hey, we're well positioned this year to assess the effects of policy firming in the back half. So they're saying we're going to hit it with 50-50, and then we're going to take a look. So now think of it as air traffic control. You're 2 degrees to the left. You're 2 degrees to the right. They're steering us on runway heading. I don't think the Fed wants to do anything at this moment to lose credibility in the inflation fight. We're going to get 50. We're going to get another 50. But they're doing what they want to do, which is keeping markets sufficiently tight, right? They wanted to take the crypto market down. They wanted to take all the excessive risks in the stock market down, right? You're absolutely right. The inventory of $350,000 homes spiked from 4 months to 9 months, right? Used car prices are rolling over the last 3 months. All the things they needed to do, they're doing, right? They need to stay the course. However, the hyperventilation this week by Bill Ackman on Twitter that the Fed needs to be doing radically more, that somehow we need to be raising rates to 6, 7, 8% in order to squash inflation, to me seems highly misdirected and totally out of touch with the fact that on layoffs.fyi, they've already announced 750 companies that are announcing layoffs, right? The market is getting the drill.
I totally agree with this. I think we're in a pretty reasonable place here. The real question is now, what do you need to take the market lower? And this is more of a nuance, but when you look at companies that are now quote unquote cheap, right? Let's take an example like we hear a lot about Google or Facebook, right? And people will say, my gosh, this is cheap. Because if you run a screen on it, it's like 10, 11, 12 times price to earnings. Well, the price because you can look on the screen. The real question is, are the earnings right? And the thing that can take the market lower is if you actually think earnings are modeled incorrectly, right? So we saw this week as well, Snap I mean, completely just blew themselves up.
46% down intraday yesterday, I think.
I just want to say something about
in
Snap.
one day.
They have the most incredible propensity to self-immolate on earnings calls than any other company I've ever seen. There's probably been 3 times, no less than 3 times over the last 4 years, where I don't know whether it's just poorly scripted or not well rehearsed, or the people that are helping Evan get ready for these things, but these are disastrous calls. You know, Facebook's had a couple in its lifetime, but Snap consistently, probably once every 18 months, will do this. Anyways, the thing just completely implodes. The stock implodes by 48% or something. And then it, rolls over to companies like Facebook and Google, who then are off 8 or 10%. My point in telling you this story is that if you think Facebook and Google, just as an example again, are cheap at 10 times, well, you better hope that the earnings are right. Because if the earnings are actually wrong, that's actually 27 times and 19 times. I'm making these numbers up to give you the example because the earnings are fundamentally wrong. So that's the risk now that's left in the market, in my opinion, that could take it much, much lower, is if that, all of this slowdown really contracts spend and the earnings are actually not accurate. The forecasted earnings will need to be revised over the next 2 or 3 quarters. And that's where we will probably see the low. If, however, growth is muted and the Fed can, as Brad said, it's a really good analogy, now just course correct by degrees, a degree here, a degree there, we've probably consolidated the lows.
What happened? Over the last couple of years, we had $10 trillion of money printing, right? Why did they do that? They thought that they could stimulate our way out of this COVID recession that they had induced with lockdowns. In any event, the point is they thought they could stimulate economic activity by printing money. And maybe cynically, politically, they thought it would be good for them in the midterms. What actually happened? That 10 trillion goes into the economy, but there's no corresponding increase in the output of goods and services. So 2 things happen. First, price levels rise and we get inflation. And second, we get an asset bubble in the stock market. And then the way both those things sort of come crashing down to earth is the Fed looks at this inflation and suddenly has to jack up interest rates. That pops the asset bubble. It vaporizes something like 14% of global wealth. And then simultaneously, workers feel a lot poorer because their wages haven't kept up with inflation. So this whole idea that you can just print money as a way to create wealth and prosperity, I hope what we take away from this, I think, recession that we're going into is that is not a viable strategy. The only thing that creates wealth in a society is the output of goods and services that people want. And you just can't try to sort of play games with that by creating this sort of phantom money that doesn't represent a real increase in goods, services, or productivity.
The unlimited and often unchecked printing of fiat currencies like the dollar is one of the strongest cases for crypto assets like Bitcoin. People only have to observe how their governments go on a monthly spending spree by literally creating money out of nothing to see the urgent need to invest in solid, sustainable crypto projects. As we see it, we are already in a bear market with a recession soon to follow. But more economic woes lie ahead for those who still believe in fiat currencies. It might take 10 more years or 20, but the greatest asset bubble burst will happen. And it is going to take many fiat currencies down to almost nothing. That is why smart investors are finding refuge in the digital asset space. To encourage others who have not taken the plunge yet, please let us know your greatest conviction about crypto assets. Why are you investing in cryptocurrencies, defeat, and non-fungible tokens? Has it helped your portfolio compared to when you invested only in traditional investment assets? Please drop your comments below and hit the like button. Thanks for watching.